Energy stocks are up 25% this year. Industrials are up 17%. Everyone is piling into the old economy trade. And quietly, behind all that noise, Morningstar just published something that tells a very different story. The entire tech sector is now trading at a 20% discount to fair value. Let's talk about what that actually means. Here's what's been happening in 2026. The Morningstar U.S. Energy Index soared nearly 25%. Basic materials rose over 18% and industrials climbed 17%, while the technology index declined over 5% in the same period. So investors have been rotating hard out of tech and into what they see as safer, more tangible sectors. That rotation makes emotional sense given the Iran conflict and inflation fears. But valuation-wise, it's created a very interesting setup. The technology sector dropped to a 20% discount from a 16% discount just last month, driven by a nearly 4% decline in the Morningstar U.S. Technology Index. Software stocks suffered the deepest and broadest declines, with many names falling 30% to 40% just this year, as the market anticipates AI may disrupt their products and lower future earnings. That's the fear driving the sell-off. AI kills software. Old economy wins. But here's what Morningstar's chief U.S. market strategist actually said about these software names. ServiceNow beat revenue expectations last quarter. Adobe posted its sixth consecutive quarter of stronger-than-expected revenue, and Salesforce posted annual recurring revenue for its AI-driven platforms up 114%. These aren't broken businesses. They're businesses the market has decided to stop believing in, and there's a difference. What makes this particularly interesting is where the money went instead. Companies linked to the AI infrastructure build-out have benefited from the rotation away from tech. GE Vernova is up over 17% this year, and Caterpillar is up over 11%. Yet Morningstar strategists warn the market may be over-extrapolating how much these industrial companies will earn, and for how long before things normalize. So the trade the crowd is making right now may actually be buying the expensive side and selling the cheap side. A 20% discount across an entire sector is exactly the kind of data point that contrarian investors pay attention to. It doesn't mean tech bounces tomorrow. It means the math is starting to look different from the narrative, and those two things diverging is always worth watching. Full Morningstar report linked in the description. Drop a comment. Are you watching any of these beaten-down software names? And subscribe to Contrarian Capital for more of these under-the-radar perspectives.